So one thing I realized when I was working on Wall Street, I was in equity research, I was talking to hedge funds and large investors all the time about stocks. I realized that some hedge fund investors pay very close attention to the change in return on invested capital. So I realized that this one time when I was talking with a client, and he told me something along the lines of the longs are actually quite easy. We just look for a rising ROIC, so a rising return on invested capital, and then those usually take care of themselves. Those companies usually do pretty well and their stocks go up. So that kind of really struck me as okay, so hedge funds look for higher returns on invested capital. I should probably do the same. Another thing that made me realize that is the coverage universe that I was looking at. So these were information services companies. These are like data companies. That's something like a CoStar, so that sells real estate data, or MSCI, they sell index data. What I realized is that these business models were actually very high returning naturally. And it took me a while to realize this. It was only after following these companies for a number of years they would grow their earnings per share about 10, 15%. So anywhere between 5 to 15%. So it's nothing crazy. But the thing is, their stocks would just continuously go up. And so over time, I realized that it was the business models that were really driving those really high returns. And that's why the stocks kept performing so well. To really make it very brief, their business model is they take data sets. So if CoStar buys up real estate data sets, this data set has been built once, and then they can continue to sell it many times. Each time they get a subscriber, they're just selling the same data set. And so you build it once, you sell it many times. And so all that capital that's been invested into that product, you don't need to keep investing into it, but you can keep making returns on that. And that's one of the reasons why they have such high returns and why those stocks do so well. So as I also started to look into more research into the market itself, I also realized that higher returns on capital are correlated to valuation. So there's this research piece by Mauboussin. It's a great research piece. I'll include it in the link. What he found, and I think this makes intuitive sense, is that when a company has really high returns on capital relative to its cost of capital, the valuation of that company tends to be higher. And it's a pretty close correlation. And it gets even stronger when you start to incorporate growth. And so that makes intuitive sense. When a company has a very high return on its business, the company's probably more valuable. So the market recognizes that. And that's why those stock valuations are higher. So that's one piece of research that really stuck with me. Another thing that we have to consider is that sometimes if a company invests too much, their returns might lower. And there's actually a great book called Capital Returns. It's from Marathon. So this hedge fund actually looks for situations where a company is actually capital constrained, or the industry is capital constrained, because then that leads to higher returns over time. And that's what their investment strategy is. They're looking for constrained capital because that leads to a higher return. Okay, so quick recap of all those things is, first thing we know that the return on invested capital as an indicator is a key metric, and looking at the return on invested capital over time, especially going into the future. Second thing is that some business models have higher returns just based off their characteristics. Usually that means that they have a kind of product or service that is a one-time investment. They continue to sell it many times and doesn't require a lot of additional capital. The third thing is that higher returns on capital do lead to, or at least correlate with, higher valuation. The fourth thing is that overinvestments can also lead to lower returns, and that has also been shown over time with companies. So there's actually a missing piece here, and I don't know if you can spot it. The thing that's missing here is growth. The key thing here is that when a business is investing new capital, they need to invest new capital to grow, and they need to invest new capital to grow at also a higher rate of return. So what we're looking for is we're looking for growth. We're looking for the incremental capital, so the additional capital that's being invested. And what is the growth from that? And what is the returns from that? That's the key point here. Let me give you an example of this. So there's this company, WD-40. If you're in the US, you may have used it. It's like a lubricant liquid. And they get actually very high returns on capital. It's somewhere around the lines of 20% or 20+%, depending on how you calculate it. And it's high returns on capital because it's a proprietary chemical. They have a name brand. And so there's not a lot of competitors that can come in and just replicate it or copy it and sell it at a lower price. The stock returns, even though it has very high returns on capital, they're actually just slightly above the S&P 500. So it's just slightly outperforming the market, but really not by much. And the problem here is that WD-40, even though they have really high returns on capital, they don't actually have that many return opportunities. They just have this one product. They might go into new markets, but there really isn't a huge market for lubricant products, or they haven't really found new markets for this specific type of chemical. And so that's why the incremental returns, they haven't been able to invest and grow at those high rate of returns. Now, contrast here is a company like Coca-Cola. You probably heard of this one, is they sell soft drinks and other branded drinks. Now, they actually had lower returns on capital, but they were actually able to increase it over time. Now, the returns on capital were still pretty decent. They were in like the 10 or 12% because they have the brand, they have also a proprietary formula for their drink. But the thing is, they were able to invest that capital at high rates of return into new markets. There's a global market for drinks. They were able to invest and sell more of their products and their brands and generate a higher return on that growth. And that's why the returns on invested capital was able to increase. And as a result, the long-term returns of Coca-Cola, even though it started at a lower return on invested capital base, their returns were actually 5 times the S&P 500 over the past 10 years. Another example is, this is something that I followed very closely, was a company called MSCI. Now, this company sells indices or indexes for institutional investors. And they also started out with a somewhat lower return on capital, about like 10% or so, but it's still fairly decent. And they had something proprietary. They had their index, which people can't really come in and copy. And that's how they are able to maintain a certain return on capital from selling that product. But the thing is, MSCI has also been able to invest in that product into new markets. So they've gone into other type of capital markets. They've invested in things like ESG. And so because they've been able to invest and grow at very high rates of return, they get a lot of profits from each additional capital that they use to invest into new markets. Because they have such a high rate of incremental return, their returns on invested capital have also increased. And as a result, MSCI's returns over the past 10 years have 6 times the S&P 500. So really great returns. So the key concept here is that we want to look at the incremental rate of return. We're not just looking at the historical rate of return. We want to look at the returns that they're getting for each additional dollar of capital that they're investing. Because when we look at businesses that are able to achieve high returns on growth, those are the kind of businesses that'll deliver us really great returns as investors. Just to hone in again, this is why even if you learn the return on invested capital calculations and you find a company with high return on invested capital, it doesn't necessarily mean you'll get high returns. You'll probably get decent returns. What you want to do is, if you want to go out and you want to find businesses that really have great returns, what you're doing is you want to look at the future returns on capital. You want a business that can generate really high rates of return on its future growth. Now, let me explain to you what that looks like in this next part. I'll show you at a high level how you can estimate the returns of the business in the future. And we'll use this with a case study of Tradeweb, which I think has pretty high returns on capital, but you can see how that actually translates into the numbers. So now we're going to jump into part 2 of the video. In part 2, I'm going to walk you through the 3 high-level steps that you can take to estimate the future returns of the business. And primarily, we're going to focus on the future returns on capital. We're going to focus on Tradeweb as a case study. Tradeweb, just for background, it's an electronic marketplace for financial products, things like corporate bonds and bonds itself. Their platform is a way for traders to make trades for those type of products. Now, the first step to do is you want to get clear on the business model. Now, at the Stock Investor Accelerator program, we like to teach investors that there's really just 5 components of any business, and you can simplify basically any business in these 5 different ways. The first thing is just the revenue model. How does it make money? 2 is unit economics. So what are the costs of producing and delivering the good? And 3 is the operating expenses. I like to call it operating leverage. So what are the costs of operating the business? Sometimes investments are included here. 4 is the actual investments. So these are the costs that are required to grow the business. Usually these are capital investments, so things that are put on the balance sheet. Number 5 is the capital sources. So what is the capital required to fund all these type of investments? And these 5 different components actually match up to the financial statements, which is why we teach it that way. It's just a simplified way of looking at a business. Basically, you can map out every business. And once you could do all those 5 things, you can start to map out the returns on capital. So Tradeweb, we can start to simplify in those 5 things. Now, the first thing is what's going on here for the marketplace is actually moving away from voice trading. So back in the day, and probably still today, there's a lot of traders that used to just make trades for bonds over the phone and do trades that way. Now, Tradeweb is one of these platforms that allows traders just to transact directly electronically through their platform. Now, how do they make money? They make money by charging a fee for the volumes of trades that are transacted on their platform. It's very similar to eBay, where they make a fee every time a transaction is done on their marketplace. They also make some money based off a subscription that they charge for the market data. From a unit economics perspective, it's all electronic and there isn't actually any product or service to being delivered. It's just a platform where people transact. So there actually isn't any costs at all. So unit economics is pretty much just almost all profit. So it's very high gross margins. In terms of the operating costs, these are just mostly costs of the employees to run the business. So this is mostly compensation costs. From an investment perspective, they're building out new platforms and new markets to match up buyers and sellers with their platform, things like cash ETFs or moving into international markets. And so that's where their investments are going to. From a capital perspective, they are free cash flow positive. So they have cash available, and they're also profitable from an accounting perspective. So they can use their own earnings and their own cash as capital to fund these type of investments. So that's a high level model. Really, if you can think about it, what they're doing is they're making money from their trading. They're taking that cash and they're investing it to build out new platforms for new markets to increase the volumes and make more money. And that's effectively how this business can grow. So the second thing we want to do is we want to start to get clear on the targets or the guidance from management on the expenses and the investments. Now, Tradeweb, they give out guidance for their expenses as well as their investments for the upcoming year. So we can use that to help us think about the capital or the incremental capital that they expect to invest into their business. So our job as investors, we want to take that guidance and we want to start to estimate the growth that they will get from their investments. So that leads us to part 3. Now our job is we want to start to estimate the returns or the profits they're going to make from that additional capital investors. Now we're going to jump into a spreadsheet. So I'm going to show you how we can do this with the model. Okay, so here we have a high level model that we can use to estimate the returns on capital for Tradeweb. I'm going to walk you through the layout of this real quick. The goal here is we want to estimate the growth of the business as well as the expenses and the investments, and then finally the capital. When we can put all those things together, we can estimate the future returns of the business or the returns on invested capital for each additional capital that the company invests. So up here, we have the key drivers of revenue. So you remember that their business model is driven by volumes and a fee per transaction, as well as market data subscriptions. You can see we have the key drivers, the volumes times the rate. So the fees per unit of volume. And when we multiply those two, we can get the revenue, which is just the multiplication of those two. And over here, we have the fixed revenues, just using the same growth rate as the prior year. So this represents the market data revenue. Now, this usually requires some more deeper fundamental analysis, but I just did some quick estimates here. So our job as an investor, of course, is to estimate the growth that they're going to get from the investments, and that's how we can start to determine returns. And for this company, we want to estimate the volume. Now, volumes, of course, are not exactly predictable, but we can look to history. And so we know that the market has grown at about 11% in volume, whereas Tradeweb has grown at about double that because electronic trading is just growing faster. That's why I've kept this 28% and just slowing it slightly down to about 25% in volume growth, which is quite high because electronic trading is taking a lot of share. And fees, because when electronic trading takes hold, it usually lowers the fees. So I'm keeping the same decline in fees of about 10% each year. And so when you put those things together, you get about 12.5% in variable growth, which is basically in line with the historical trend of Tradeweb. So it's not a crazy estimate. Same thing with the fixed trend over here. These are the market data rates. It's basically in line with the industry, maybe slightly faster, but at that 5 to 6% rate. So that gets us to our revenue model right here. So we can see that we put in the variable and the fixed, and the total revenue change you can see down here as about 10 or slightly over 10%. Now, when we want to look at the expenses required, Tradeweb has disclosed their adjusted expenses. So I've just put that over here, the adjusted expenses, and I've just separated out depreciation and amortization over here so that we can calculate earnings before interest, taxes, depreciation, amortization, just to get a sense of the cash earnings. We'll just hide that over here. By taking the revenues and minusing the expenses as well as the depreciation amortization, we start to get the operating income. Now, operating income is a profit of the business before interest and tax. So we have interest here, we have tax here. And then from a return on invested capital standpoint, we want to remove the interest because interest is usually related to payments to debt holders. And when we're looking at return on invested capital, we want to look at the returns that the company is making before it pays interest. So that's why you usually start off with operating income and then we minus the taxes. So I'll show you that later. Of course, once you take away the interest and taxes, you get to net income. And of course, when you divide that by the number of shares, we have our adjusted EPS per share. So just a quick analysis here. We have our revenues of the business. We have our earnings of the business. A couple of things to highlight is now we can look at the margin of the business. So how profitable is the business based on these estimates? So here's where we get into more of the assumption. When you want to start to build a model, you have to start making some certain assumptions. I've put together the adjusted operating expense over here. I've estimated it based off what their guidance is. So 75 to 805, I've just estimated it as a percentage of revenues and slowed it down or taking it as a slightly slower rate going over the years. So just assuming that they're getting a little bit of leverage, meaning they're getting a little bit more efficient with their costs. These are the margin assumptions. And because they don't really have much gross costs, I've just basically excluded it here just to keep this model very simple. It's just basically revenues, operating expense, and adjusted operating income. Now, when we want to start to estimate the capital that is required for the business, there's two ways we can do it. We can start off from the asset side, or we can look at it just from the capital side. I'll show you first the asset side and what that looks like. So let's move over here to the balance sheet assumptions. So there's two types of capital, really. It's either working capital, and that's the type of capital that's used to day-to-day operations. For example, from an accounting perspective, you have something like an accounts receivable that just represents cash that you're expecting from customers, or an accounts payables, cash you're expected to pay to your suppliers. Those are usually called operating assets or operating liabilities. So together, they represent the working capital. So just money that's being used in the day-to-day operations of the business. So we can model that over here. That's I've modeled the operating assets and operating liabilities. I've kept it very simple. Operating assets, I've just estimated it as a percentage of revenues because it's usually related to sales items. And then operating liabilities, because it's things you're paying out, it's usually related to expenses. So I've estimated it as a percentage of expenses. So again, this is a very simple model. When we take the assets, the operating assets minus the operating liabilities, we get the capital. And because liabilities is higher, meaning they're not paying out as much versus expecting money to come in from the asset side, that's why their working capital is actually negative. It's a good thing. It means they don't have to use that much capital for their day-to-day operations. And the other thing I've also estimated here is the minimum cash to run the business. Sometimes companies will disclose it. Sometimes if you ask their investor relations directly, you can get a sense of that. But they've talked about their regulatory capital being about 82 million. I've heard of some companies requiring 200 million, but just to be safe, I've estimated about 500 million, which is probably a decent amount. Now, the second thing are the other investments on the balance sheet. So here we have our capital investments. We have our property and equipment. They've guided to a certain amount of CapEx, so capital expenditure. That represents investments going into property and equipment, and those are put onto the balance sheet, so the asset side. That's why we have the property and equipment here. And I've estimated it as a percentage of revenues, just because as the business grows, it should require more investments. Then we estimate depreciation just as a percentage based on the prior year. And so when I put all these estimates together, we can get the property and equipment, add the CapEx minus depreciation gives you each year the property and equipment asset year by year. Same thing with the software development cost. So they've capitalized, meaning they've considered their software costs as an investment. So they put that on the balance sheet. They're adding about 57 million to their software development as a capitalized cost. And of course, I'm just using based off prior years. So how much is it expected more amortize, which is just a decline, representing the same thing as depreciation, but just for software or intangible type of assets. So we add the software development costs, we add on the additions, and we minus the amortization. It also gives us our asset line. So this is the capital that they're investing, meaning they're putting on their balance sheet, representing the property and equipment, representing the software that they expect to invest in to generate future growth. That's our investments. Now, there's other assets that are required to run the business. From an accounting perspective, we're looking at really long-term assets here. And I pulled out the intangible assets because that represents things like customer lists or maybe brand. So things that they've accounted for that are not like physical items, but intangible things, non-physical items. Of course, you can't just throw away your brand, right? Or throw away your customer list. Same thing with goodwill. So goodwill represents the additional premium. If a company acquires a company, that additional premium over the fair value of the balance sheet. So they've obviously made acquisitions that are important for the operation of the business. So I've kept that as an asset that is important, or capital that's required by the business. There's a number of other line items on their asset side. I'm sure we won't go into in detail because it just will take a long time. If we put all these things together, that effectively represents the capital that is being used by the company with the additional investment. So here we've summed up the total invested capital. You can see it's a sum of the total working capital, which is negative because the liabilities are higher, which means they are expecting to owe more money. So they actually don't need a lot of cash for the day-to-day, but I've added in the minimum cash. I've added in the property and equipment, the software development costs. as well as the intangible assets, goodwill, and the other assets. So that gives us a total invested capital. Now, with this model, we have total invested capital. We can see how that changes over time. And now, in order to calculate the return on invested capital, all I have to do is take the adjusted operating income minus the taxes. So that gives me the operating income after taxes. We're not incorporating interest, just taking away taxes. So that represents the returns or the earnings of the business. We take that as a percentage of the average from the prior year total invested capital and this year invested capital. We're taking the average because it represents the returns over that time period. It's just taking between those two values of capital. And then that gives us a return on invested capital. And you can see this going up slightly. It's partially because they're spending at a slower rate than revenues are expected to grow, at least from our model. They're growing their expenses at about 10.5, and they're growing their revenues at slightly higher. And of course, that leads to an increase in margins, and that leads to also an increase in return on invested capital. The other thing here is we've also calculated the 1-year incremental return on invested capital. Basically, so if we assume that the company has invested a certain amount of dollars, right? So these are the additions to property, equipment, and software and development. What is the additional profit that they're getting from the additional dollar? So I'm taking the change, so the additional capital, and then also the additional operating expense, and then working out the increase in operating income after tax, and then comparing that versus the additional capital that's being spent. So that gives me an idea of how efficient they're using their capital. Because what this is saying, if it's 75%, it means that every additional dollar of capital that they're investing in, they're getting about 75% of that back in profits. Now, that's pretty good. And of course, that tells me that this is a pretty efficient capital grower. As long as they can keep investing at these sort of rates, this stock should do really well. The other way that you can look at return on invested capital from the capital side is you can also look at it from the perspective of capital being invested in the business. So capital can come from either two ways. It's just from liabilities or debt. So things that they borrow, or equity, and that's when they sell shares. And so this is just comes from balance sheet. We've got the long-term liabilities over here. I've honestly just kept the historicals and just kept the same liabilities. So they don't have any debt. So I'm just assuming their liabilities remain fixed. In terms of equity, because they pay out a dividend, that would represent an outflow in terms of if you make earnings, you have to pay out some of it in dividends. So we want to note that down over here because it comes out of your equity, right? You're paying out your earnings to your shareholders. And if you do share purchases, and I'm not assuming they're doing any over the next couple of years because they're using share repurchases just to offset share compensation, because we're not modeling any share compensation. I'm not going to model in any share repurchases. But here we have our equity side. So it just represents the additional capital, which is the money that was already put in. And then the retained earnings represents the net income minus any amount that's paid out in dividends, and it's added on to the prior retained earnings. So it just represents the total earnings that are retained by the business, and that's what's considered equity. I've taken away the excess cash because they make a lot of cash. So I've just removed all the cash except the 500 million of estimates, and I've just modeled that going forward just as a percentage of revenues. When I take away the excess cash, now I have my equity minus the excess cash. When I add in the equity plus the liabilities, so we have the equity liabilities, that represents the two sources of capital. You can see that exactly matches the total invested capital from the asset side, because the assets should always balance with the liabilities. All the assets should be either funded by either debt, liabilities, or equity. And that's why it balances. So we can see we have the same calculation for return on capital over here. So that's how you can model it. This is actually a pretty simple financial model. And of course, this is just all neatly tied in here with the balance sheet and then the cash flow. I can also work out the free cash flow from the company with this model. It's a very simple model for TradeWeb. Now, the other thing is we've looked into the incremental returns on invested capital. That gives us a sense that they're taking that additional dollar. They're quite efficient in generating returns on it. Another way that you can look at, this is the metric that I wanted to show with you that's not that well known or used, is the incremental operating margin. So just the same way I want to look at for incremental return on capital, which is the additional profit per dollar being invested. Incremental operating margin will tell me, okay, so for each additional sale the company makes, what is the profit they're making on that? So that's the incremental margin. That represents how efficient and how profitable they are with growth. You can see that their incremental margin is pretty good. It's about 50%, which is quite high. And I think it's slightly higher then at least from our estimates, they're slightly higher than the current operating margin, so the current profit margin. So that just tells me if they follow this type of trajectory, which is just keeping expenses slightly lower than revenues, you start to get a higher profit each additional sale you're getting. That's also an indicator that the company is becoming more profitable over time. And when it becomes more profitable over time, it starts to have higher returns on capital. So you can see why putting in these two estimates, we put in our return estimates with our investment estimates, we can start to see what this business will look like in the future. Is it making additional returns? Is it making additional incremental operating margin? And also, is it making higher returns on capital? And most importantly, is that rising? Because if this return on invested capital is rising, the company's value should also increase. One more important thing here is we've actually excluded out all the cash that is actually being generated. So if we're looking at this model, it's actually very profitable. We can see that the free cash flow is quite high. So it's about 500 million, 589, 65, 650 million. So this is actually quite high from a free cash flow perspective. But because I'm taking away the excess cash each year to calculate the actual invested capital, this is just representing the returns of the business if we remove that extra cash. But that cash can also be used to generate additional returns. They can make acquisitions, they can do more share purchases, they can just give that cash back to shareholders. And even though this business is generating about 10, 11, 12%, which is quite good, they're actually generating a fair amount of cash, $9 a share, $11 a share, $13 a share. If that is added back to an investor's return, either through share purchases or even dividends, what that does is it increases the return. And that's what happens with some of these stocks that generate a lot of free cash flow. Their underlying returns might be like 10, 15 or so, which is really good, especially if it's increasing, but they're also able to take that cash, maybe make acquisitions or just give it back to shareholders, which increases the return. Obviously, the best use of cash, if they can, is either both to reinvest in the business and keep growing, or just give it back to shareholders with repurchases. Now, a couple of things that hopefully you can see from this model is there's a couple of things that will improve returns for a company. First thing is leverage. So if the company can keep its expenses relatively tight, or it just doesn't have to grow as much, you start to get higher operating margins and also higher returns on capital over time. Second thing is just a low cost of replication. So here, Tradeweb, because they don't really have much cost when it comes to producing their product and service, they just have this electronic platform. It's all electronics, so very low cost. That's why they can have such high margins. So that improves returns. Another thing is efficient capital use. So you can see from our quick analysis here is that they don't require a ton of working capital. They also produce a lot of free cash flow. So that cash actually can be used for acquisitions, but it just generally means that the company is very efficient at producing cash and getting higher returns. And finally, the last thing is, if we think about this at a high level, the reason why this company generates a lot of cash and doesn't require that much investment is because they're continually getting new revenues. They're getting revenues from people constantly trading on their platforms. So you get this recurring revenues. You don't have to keep making new product every time. That's very efficient. That increases your returns as well. So when you can estimate the incremental returns of the business, you really move from being just a novice investor who just knows formulas to becoming more of an informed investor with real professional skills. You have the professional ability to start to pick out businesses with really high returns. Now, the most important thing is you want to start to apply this, right? I want you to look at business and estimate the returns by following these type of steps. If you like this, please subscribe because you'll get more videos like this each week. And if you like it, please like it and also leave a comment. It really helps us make more videos for you. And if you want to learn how to do this, we also have a free workshop where we get into more detail on the framework. So check it out in the link below if you're interested. And otherwise, thank you for watching.